Hey, good morning, everyone. Welcome to another episode of Policy and Profits. I am, if you notice my background, I'm on the road in Utah visiting some investors. Happy to be joined long distance this time by EJ Antoni, economics extraordinaire. EJ, how are you today?
Anthony, I am hanging in. Been another crazy week. A lot of up and down data, up and down markets, but we are hanging in. How about you?
Doing well. Markets have been pretty crazy. We, just for reference, kind of on top of it, though, keeping me up at night, but on top of it, year to date, as of Friday's close, we were actually up 9.5% for the year at Island Capital, which I'm very happy with. That rocky road is not paved and clear, but it's we're managing and maneuvering well, and we're getting some good signals. So definitely difficult, not sleeping too much, but happy with the results. Really happy with the fact that we're getting some adults in the room as far as Washington and policymaking and some voices that are making sense finally. Mr. Bessent has been just on top of his game. We said a few weeks ago he's the first member of any administration, member of the Treasury, member of the Fed that has actually come out and talked about the right things. One of which was the fact that the 10-year is what they're focused on and not the Fed funds rate. I'm so happy to see that, and I know you are as well. We've talked about this a ton. That shiny ball, the Fed rate ball that bounced around for a decade, is finally off the table, and we're looking at the 10-year yield, which is great. There was a great interview, and he talked about market volatility. Again, the adult in the room. We have that cut. I'd like to go to that, but let's listen to Mr. Bessent.
Let's talk about what happened in the stock market this week. Worst week for the market in 2 years. Does that worry you, Mr. Secretary?
Not at all. I've been in the investment business for 35 years, and I can tell you that corrections are healthy. They're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. It would have been much healthier if someone had put the brakes on in 06, 07. We wouldn't have had the problems in 08. So I'm not worried about the market.
Love it. I love it. You're talking about, the worst week listen to the words, the worst week we've had in 2 years. Oh, by the way, those 2 years were a 40% return. We've had a bad week and people are starting to get nervous. And you're talking to him, who's a 30-year veteran and probably put on one of the most historic trades in hedge fund history. I'm going to jump to another clip of you from this week, and then I really want to hear what you have to say about where the risks are. This was a great cut from Kudlow, talking about the risk and what we're seeing and what that spread looks like between policy and effect.
On that note, probably the best chart I saw this week came from Apollo. They had the letter A, where we are now, and the letter B, a little bit higher, right? That shows where we could be as a nation with greater manufacturing, lower taxes and those sort of things. And the question was, getting from A to B, people are bringing up the word pain, transition, these sort of things. From your vantage point, how does it look?
I think it looks like a period of detox, a period of sobering up, Charles. Unfortunately, what we've basically been through has been an economy that just moves from sugar high to sugar high, right? And every time things started to lag, government was there to just give it another shot in the arm, like Judy and you were just talking about with all of these government hires. That certainly made the payroll numbers look really good, but it didn't do much for the real economy, for the productive private sector. In fact, there was actually 1 month right before the election where the household survey showed 700,000 additional people employed by government. Now, that did wonders for the unemployment rate, but it didn't do anything for actually improving the lot of the average American. And so, again, to you guys' point, what you were just talking about, how on earth do we get out of this? That period of detox might look like some of our official statistics not being that great, but the official statistics have been great for 4 years, and the average American can buy less today with their paycheck than they could 4 years ago. So I'm not really that concerned about what GDP looks like. I'm concerned with what can the average American actually afford? What's their standard of living? What's their cost of living? Right. Those are the things that I want to see improve.
All right, EJ, so tell me, what do you see? That was a great clip, great interview. What do we see here on this spread between what we're fixing and putting the policy in place, and then the fix actually being in? How ugly could and should this get?
Well, you just mentioned the returns that we've seen in the market over the last couple of years, right? And the fact of the matter is, a lot of that is just they're phony numbers, quite frankly. Let's call a spade here. So much of the stock gains that we've seen, because these equities are essentially priced in terms of the future earnings of these companies, right? That's the only thing that ultimately justifies a stock price. The future earnings are just, I think, wildly off, and they have been for quite some time. The rally in a lot of the tech stocks, the Mag 7, for example, that I think is a very, very good indication. So what's caused all that? Well, the government spending all of this money, which it is spending by taking on debt. It's hiring government employees. That's making the jobs numbers look good, but it's not actually adding to the productive private sector. And even those consumer spending numbers that we've talked about so many times, when those consumer spending numbers are really just fueled by government transfer payments, that's really government spending. It may not get counted like that in the national accounts, which is how we get GDP, but that's still the reality. So I think as you start to reel all that back in, as you stop this constant barrage of debt that the government is using to throw everything in the kitchen sink at the market, some of these numbers are going to start looking pretty grim. But that's not actually a bad thing. In the same way that the exploding GDP figures we've had for the last couple of years haven't been a good thing either. I mean, when the numbers are phony, they're meaningless, and unfortunately, that's what we've seen. We've seen these meaningless numbers over and over again. But look, at the end of the day, the average American can buy less today with their weekly paycheck than they could 4 years ago. And that's despite that weekly paycheck getting significantly bigger, right? So things have gotten worse, not better. According to the Atlanta Fed, we are at right now the lowest level of home ownership affordability since the Atlanta Fed started keeping records. That's terrible. The National Association of Realtors shows that pending home sale activity is 30% below where it was in 2001, not 2021, but 2001. So a quarter century later, and things are 30% worse. All of these indicators point to the economy being worse, not better, regardless of what the official numbers are telling us. So, as you go through the detox period that Secretary Bessent has talked about quite a bit now, it's going to look worse in the same way that when we got on this sugar high, essentially for the last several years, the economy looked better and better. But again, the reality is for the average American, the situation was getting worse, not better. And so this time around, as you flip everything on its head and the official statistics start taking a nosedive, and the average American's life is getting better, as their quality of life goes up, as their cost of living goes down, I'm going to count that as a win.
So kind of the thing I'm trying to wrap my head around, and we'll get into the market in a minute. My model, my work runs in different periods. So I can run it in any period really, but I run the 30-minute as kind of a key, an indicator. I don't trade that. I run the daily, the weekly, the monthly as really my main model. The damage done on the daily, the weekly, the monthly so far is different and more significant than the damage we've seen before. So what I'm trying to wrap my head around to connect the model and the technicals and the market to the actual economic growth expansion and redirect and cleanup or detox is if we had fake numbers on the way up and the market continued to rally with that, and now the numbers become real and look much worse. I mean, I'm expecting that market participants are going to work off of the models they always have, and we're going to see the market really draw down further because we know that these numbers are going to look a lot worse before they look better. Even though we're improving, the numbers are going to look horrible because we're detoxing. Does that make sense to you from your side of the aisle?
Yeah, Anthony, absolutely. That's really well said. And this is where we go back to something you've highlighted in several episodes now, where you say that the headlines are interchangeable, right? Your modeling work clearly shows that things are overvalued. And it doesn't matter what the excuse is for people to agree with that finally, to capitulate, to sell, to say, oh, wow, things are really overvalued. I got to get out now before equity prices start going south, whatever the case may be. But I think the essentially the data that you have in your modeling, I think that lines up really, really well with a lot of other data that show the typical American is much worse off today than they were just a few years ago, right? And so there's your disconnect between where the market by and large is evaluating the value of these different companies and where the real value of these companies actually is. It just isn't at current valuations. It's not. Now, maybe things turn around, right? Maybe we get the tax cuts and we get the deregulation and the tariffs work out really well. Let's say all the dials line up. Energy production goes through the roof. Cost of production drops through the floor. Everything, all the dials line up correctly. In a couple of years, are these valuations going to be realistic? Yeah, sure, that can happen. Absolutely. But are we there right now? I just don't see it. Again, neither your modeling work nor the data that I look at support these prices.
Yeah. Yeah. And remember, like we have things that are being set up to succeed, exactly to your point, in 4 to 8 quarters out, which just needs to play out. But what's happening now and this detox is, so if we do start to onshore more business, if there are tax cuts, if we drill, baby, drill, and prices come down and inflation has that, I know you and I talked about this, we're expecting an uptick in inflation, but not to the level that we saw under Carter because the policies under Trump are more in control of keeping prices down. So it's not going to run away. We're not going to have the same mistakes made, but the mistakes that have already been made need to be flushed out. So all those things will happen. But as we're improving, we have massive cuts going on with the government. That's going to affect the job numbers. That's going to affect spending. As you just said, consumer spending, those numbers are going to draw down. They're not going to draw down necessarily because consumers are overextended, which they are. And they are hurting and they are overextended. We know that, but they're drawing down as well because the transfer payments and the government payments that were being disguised as consumer spending, that's going away. So the negatives for the next year to two will probably outweigh what we see as positives. And then as we clear, I kind of envision it as like the clouds kind of separating and going away, the sun coming out, and the golden age of America, or the economy and the country really moving to the right direction will come out of that muddy path, but that muddy path is going to be pretty difficult for the next 2 years, which I think is a fair timeline. And the markets should not react well to that. It's going to be a difficult time for the markets.
Anthony, spot on. I think that's a fabulous analysis. Everything you said is correct there. I just want to piggyback on the point on Carter. We essentially, we've showed this a couple times now on the show, where we overlay today's inflation with the inflation from the 70s and even into the very beginning of the 80s, and you get not just the one peak, but then you get a second, much larger peak. And that's for a couple of different reasons. One is the fact that the Carter administration just wouldn't stop the spending. Right now, a lot of that, did they inherit that from previous administrations? Absolutely. They inherited a ton of mistakes, but then they doubled down on them and they kept going. It wasn't until Reagan that we got, the real reforms on the fiscal side. The other thing was that on the monetary side, Paul Volcker, as much as he has a great reputation today as the slayer of the inflation dragon, he made a lot of mistakes. Interestingly, 8 years almost to the day before he took the helm at the Fed, he was one of the people who helped convince Nixon to take us off the gold standard, to finally close the gold window to international transactions. A lot of people forget that. Maybe the reason he was such a strong crusader against inflation at the Fed was he was trying to atone for his past sins. But whatever the case, in that election year, he takes his foot off the brake. And that's one of the things that helps give us that second bout of inflation. Now, Powell did the exact same thing, right? And so that is one of the reasons why we've seen an uptick in inflation since September. However, again, now we have exactly the opposite in terms of government spending. We have an administration that is really trying to slam the brakes on, and hard. At the same time, you have a Federal Reserve that has essentially no interest anymore in any kind of easy money policy. right? What they're basically doing is slamming on the brakes now. We're talking about higher for longer yet again. And so I think we're going to, as much as we're not going to get any help from the Fed in terms of coordination with the Treasury, I do think it is going to help us from the standpoint of we don't have to worry about another series of rate cuts that are going to exacerbate inflation.
You know what, EJ, to that point, let's take a look at the market and kind of what we're looking at and how this should all play out or is playing out. So we had a really nice chart was put up by Geiger Capital on X, and I've made some comments on some of his charting before. He does a great job. He's got some great posts. This one in particular, and I said this last week, we've had now a 10% correction, and we typically have a 10% correction every 2 years or so. We've had one this year, we had one last year, we had one the year before. So this year, 24, 23, and then in 22, remember, we had a 28% drawdown from like December of 20 into Jan of 21, all the way through to mid-Jan 20 to mid-21. And then in 22, we had the drawdown, Jan of 22 to mid-22, we had that drawdown of 28%. And then we had two 10% corrections, and now we're in our third 10% correction. So his point was not a big deal. It's another 10%, move on with it, which I get. We have 10% corrections. My challenge to this would be everything that you've just talked about is different than it was previously. In addition to the fact that this 10% correction has come from a topping pattern versus a more direct failure or peak to trough failure and then resumption. So this correction doesn't look like the others because we came out of a topping pattern, which was a 5-month pattern. That's significant. It also came from a Shiller PE, which I talk about a lot, that was second only to the tech bubble level. So heading into 2000, the inflation adjusted PE for the S&P 500 was at 44. We were approaching 39 before we started to crack here. That's another key point. And then you add in the over leverage, the overextension, and the fact that this market was so concentrated in the Mag 7 and in AI, and the breadth of the market had not spread at all through this whole rally. We're talking about 60% of the S&P 500 earnings growth coming from the Mag 7, almost 40% of the market cap, 40% of the market cap of the S&P 500 coming from the Mag 7. And I said this last week on one of the shows I was commenting on. You live by the sword, you die by the sword. My opinion is that this is not just a 10% drawdown. And we can go to the other chart, which I had put up on my weekly report last week. This is the beginning or the recognition phase of a coming bear market. I have no doubt. And I personally, in my opinion, I have no doubt that the S&P cash will hit 5,000. Now, back in December, I called for a move down from current levels. We were at about 6,000. I called for a move down to 5,500 as the first 10% marked that up. Our low on the S&P cash last week, which was a brutal Friday, was 5,504. So let's call that a check that box. There are going to be moves and rallies within this move, but I will tell you that with every bear market, we have bear market rallies. They're called that for a reason. This market will see 20% at 5,000. And keep in mind that 20%, in my opinion, we will see 5,000. And keep in mind that 20% down to 5,000 is just the beginning or could be the beginning of the move or the, 2/3 to 1/2 move down. Again, in 22, we had some things to work through, Ukraine and the Fed raising rates. Real issues. We were down 28%. Forget 2008, 2009, down 58%. To move down 10% from where we were and call that the end of the show, let's keep moving higher, that's fine, but show me why. I have more reasons why and more technical damage done in my model and my work as to why we would go lower from here versus higher. So I continue to say, as I've said since December, I'm a seller of the rallies. I am not chasing rallies. I was a buyer of gold in December. I still think gold has legs to the upside, although it is at a massive run. I'm a seller of rallies in the S&P. I am a buyer of volatility on dips. And I think we see at least another 10% down in this market, potentially another 20 to 30% down before this is all said and done. So I think we're going to wrap it up there for the day. EJ, thank you so much for the insights today. Wonderful as normal. Can't thank you enough, and always an education. I will see you again next week, my friend.